Hello, and welcome to our webinar featuring Sarona Fund 3, an investment for clients of the Giving Fund, a program of ImpactAssets. I'm Sally Bolter, Senior Officer for Client Experience at ImpactAssets. ImpactAssets is a nonprofit financial services firm that was founded in 2010. Our mission is to increase the flow of capital to impact investing through field building and innovative product development, including our donor advised fund, which has over 800 accounts and $300 million in assets under management. Currently, we are offering Sarona Fund 3 through the Global Impact Ventures platform, which provides curated private debt and equity options that seek to generate significant social, environmental, and financial returns at a low minimum of $25,000. Previous options have specialized in natural resource conservation, microfinance, sustainable agriculture, frontier and emerging markets development, and more. ImpactAssets is particularly excited to welcome Sarona back onto the Global Impact Ventures platform. Today I am joined by Vervina Berla, the co-managing partner of Sarona. Vervina, welcome. I understand you joined Sarona at its inception 5 years ago. I'd like to start with hearing a bit about your background and how you became involved with Sarona.
Sally, thank you so much. And first of all, thank you so much for inviting Sarona and choosing Sarona to be one of the products on your platform. It's a real honor and pleasure to be able to speak with you and to your clients. My background, it's a very rich and varied one. Over the last 20 years, I've worked in institutional asset management firms such as Merrill Lynch Investment Managers and Gardmore in London. And before that, I had 10 years in the industrial world, working across Africa, Latin America, and Asia. But I really became whole when I discovered that it was possible to create a firm like Sarona. And the reason why I say I became whole is because at Sarona and with my partners, including first and foremost Gerhard, who is the visionary with us and behind us, we are targeting private equity, which is something I have spent a lot of time on, in frontier and emerging markets, which I believe in, and everything based on ethical, social, and environmental values, which is something that I have not often found in the traditional financial world.
Fantastic. Tell us about Sarona's impact thesis and how you all are unique.
So what you see on the screen in front of you is really our 3 pillars. And Gerhard and I are managing Sarona to deliver all our activities to meet those 3 underlying criteria. 1, all our activities are based on making private investments in frontier and emerging markets. Secondly, we are designed to build a portfolio that seeks and hopefully delivers strong financial returns to its investors. And finally, as I was saying earlier, ethical, social, and environmental values is something that we hope is going to make us different from most of the existing players in the financial sector. The next slide shows the geographies where we plan to invest and have invested for the last 20 years or so. In gold, you see 106 countries, which are really the low and middle income countries as defined by the World Bank. And in dark brown, you see the countries in which Sarona has already invested to date. Part of the impact thesis is it is possible to deliver private capital to make a difference to the way entrepreneurs do business in these countries and generate returns while at the same time providing and making a significant difference to the environment and the communities in which this business operates.
That is really interesting. Tell us about the growth drivers behind your strategy.
Well, as I mentioned earlier, we aim to build portfolios that have these double objectives of making a positive difference where we invest and at the same time generate strong returns for our investors. In order to try and achieve both, we think that there is a number of trends that are specifically present in emerging markets that make our success more likely. And these are long-term trends. These are not going to go away in the next couple of years. So everything we do is about doing it for the right reason and over time. These trends for growth are things like demographics. The countries in which we invest tend to have a young population that is in their working age group and is able to provide really significant skill sets to the companies that we are backing and supporting. Urbanization, already 50% of the world population lives in cities, and cities are growing faster and are able to produce more and generate higher demand than countries overall. The most significant trend is probably the one of the emerging middle class in our countries. There is billions of people that are moving from being poor to becoming middle class. And as they reach the middle class segment of the economy, their ability to spend and consume increases as well. As consumption increases, the opportunity for local manufacturers and suppliers of goods and services increases. And so our investment thesis is that if we provide capital to these local producers who are then able to grow their companies to meet the increased demand from the growing middle classes, we have a win-win situation for local producers, local demand, local economies, and investors who try to tap into that thesis.
Thank you. Now, the next slide has a lot of information on it. We'd especially like to hear about your diversification strategy and how you settled on the various targets.
In private equity, we believe there is really only two ways of generally managing the risk of a portfolio. The first one, and possibly most important, is selection. You have to select the right investments and then add value to them. But the second way of managing risk is through diversification. And in private equity, especially if you are like Sarona investing in a collection of different fund managers, there is plenty of scope to achieve diversification. The first one is by country, and you have seen the map, and you can see that we diversify across a variety of both continents and regions. The second one is by strategy and type of fund that we invest in. And that is where you see that we have designed a program where we invest a minimum 60% in primary funds and 40% in secondaries and co-investments. I will not go into the details of that, but let me just say that diversifying across those dimensions helps reducing a number of undesirable characteristics of private equity characteristics. Mm-hmm. We also invest across managers. We will invest in between, I suppose, 10 and 18 different fund managers. We will invest across time. That is often a dimension that investors do not appreciate. Private equity, like listed equity, is very cyclical, and it is important to have time to invest across cycles, and we do that. We also diversify in terms of sectors. And what you see here and how we have reached those targets is really trying to be sufficiently diversified to ensure that we don't take too much risk in any specific dimension, while at the same time to make sure that we are sufficiently broad to make sure that we can cover and deploy the $350 million of capital that we're trying to raise for Sarona Frontier Markets Fund 3.
Super, that's very helpful. Sarona has a very strong reputation for ESG investing. How do you consider social impact in your investment approach?
It is essential for us that we are able to deliver on what we have promised ourselves and our investors, not just in terms of return, but in terms of impact. And the debate and the discussion across and around impact investing can sometimes be distracting. So we have tried to clarify things schematically. First of all, there is the way that we approach ESG, environmental social governance criteria, and separately, how do we ensure that the ESG criteria and practices deliver on an outcome that is impactful for the community and the environment in which we operate. And we do it in two ways. We do it ex ante, during due diligence, before we invest, and we have a set of questions that we ask our investees to respond to during our due diligence. And then we have the ex post approach, which is having decided to invest in a particular fund, having raised with them their consciousness about how important it is to do things well, and by the way, our tagline is growth that matters. We then measure and ask our fund managers to measure how the companies are performing across 6 different main categories. We follow the IRIS metrics, Impact Reporting Investment Systems, and once a year we consolidate all those metrics and all those reports to deliver a statement that says not only have we created X jobs, but we have improved the job quality. Not only have we empowered women generally, but we have ensured that a certain number of women are either working for the companies or benefiting from the company's activities. We are encouraging the fund managers and the companies to reduce their environmental footprint, and we measure that impact. Improving governance, that is important not just for having impact, but to ensure that the companies are behaving as responsible citizens, and in so doing increase tax payments and local tax receipts. And finally, as these companies improve their presence and the way they operate in the communities where they work, we measure and encourage the building of sustainable communities. And those are the 6 overarching themes that we follow, monitor, measure, and report on when we invest.
Wonderful, wonderful. This is Sarona's 3rd fund. How will you leverage the experience from the previous 2 funds, and what do you expect to see in your pipeline?
So what you see here is the same map that you saw before, except that you have little triangles for the 6 regions in which we break our investable universe. Latin America, Middle East, North Africa, Sub-Saharan Africa, Central Europe and Central Asia, South Asia, Southeast Asia. The way we leverage our previous experience really is driven by having had that experience. it is incredibly difficult for investors to have visibility in what is happening in these countries, regions, from a point of view of private equity markets. Private equity are called private equity because they're private. And so to gain information about how these fund managers operate, in fact, just their very existence is very difficult. So having a pipeline, and what you see here is the triangles is number of funds that are in Sarona broader sweet spots. It's the lighter blue, the candidates for interim and deal alert, and then the number of funds who are likely to receive on-site visits. This chart is really the result of 5 years of experience and hard work. And if you can flip to the next slide, please, what you see here is the funds in which we have invested from our Sarona Frontier Markets Fund 2. And I mentioned earlier we invest in primary, secondary, and co-investments. You see on the right the location of where our fund managers are based and where they're active and where they invest. This is $150 million that we raised from for our Fund 2. We have now already committed $130 million, which is why we are now raising Fund 3. And what I can say is that Fund 3 will look very similar to Fund 2. And so the likelihood of seeing a very similar allocation is very high.
Excellent. What risks have you identified, and what are your plans to mitigate them?
The first thing I would like to say is that usually anybody who is considering investing in frontier and emerging markets tend to have a perception of risk which is significantly higher than ours. The way Sarona looks at the risk in these countries is from the point of view of somebody who has lived and done business and executed and implemented for the last 20 years in the case of Gerhard and for the last 40 years in my life. And it is specifically because of this gap between perceived risk and real risks that we think we can add a lot of value to investors and investees by deploying capital to them. But saying that there is a gap between perceived risk and real risk doesn't mean that there are no risks. They're just different risks. And so on the left, you see macro-political currencies. Of course, if you're based in the US, you're going to perceive the risks in Nigeria, Egypt, and Colombia as different. But they can be mitigated. They can be mitigated through diversification and through a long-term investment horizon because, as I said earlier, private equity in general, investment in particular, are cyclical. So long-term helps. Specific risks in these countries that we have identified are corruption and the danger of government intervention, especially if an investment is large and successful, which we don't do. We usually do smaller investments than successful investments, which is part of the mitigant. We want to have robust policies and procedure in place when we invest in our managers, and we focus on smaller companies to avoid government greed, I suppose I can call it. Another risk is immature private equity markets. When you invest in the US or in Europe, you're investing in a fund that is generation 8, 9, 10. When you invest in emerging markets, private equity is much more immature, and usually the manager are younger. So we have to do extra careful due diligence and GP selection to mitigate that risk. And finally, minority positions and operating rights. This is entrepreneurs who are selling their company for the first time. They don't want to sell the totality of their company. When KKR or Warburg Pincus or the large private equity managers buy a company in Europe or in America, they're willing to put $1 billion, $2 billion, $3 billion to work to buy a company, do some financial engineering, increase its value, and then sell it. That's not the business that we're in. And so the business that we're in is much more rewarding, has much more impact, but presents some risks. And we mitigate that by choosing the best possible locally based fund managers. They have to be able to go into the companies, hold their hands, sit on the board, make sure that they understand what the company is doing, how they need to grow, and how they can improve their operations. And therefore, that's where consideration of ESG issues become even more important with these companies and in these geographies. So we think that we are the perfect strategy to identify, manage, and reduce the risk of investing in this market segment.
Great. The next slide highlights two funds in your portfolio. Please share with us why you've chosen these two to feature.
Because they're so very different from each other. And we thought we wanted to try and provide you with some interesting case studies and stories that have been successful both in terms of financial returns and in terms of the difference that they've made to the communities where they operate. So these are two funds and two different companies. Candeo is a fund that is based in Colombia but has also offices in Peru and Mexico and activities in Ecuador. Progresemos, which is one of the companies in this fund, is a microfinance institution in Mexico. And what you see is that by providing capital to microfinance institutions, they have allowed Progresemos to increase and strengthen their balance sheet to reach more clients. As I was mentioning earlier, for us women and the way that women are either served and or employed is important. And so thanks to the capital that Candeo has invested in Progresemos, the company has been able to increase the number of clients served in 2015 by 54%. 83% of these clients were women. 85% were rural clients, which are the hardest to reach. And 87% were low income. We check the employees. We check how the company treats those employees. And here you see that in the case of Progresemos, they grew 15% year on year, and 59% are women. We also chose these two companies because Sarona has, thanks to the Canadian government, a grant facility which is administered by MEDA, MEDA being the Mennonite Economic Development Associates, from which Sarona bought itself out. And these grants, which are called Sustainable Innovation Grants, have been used by the companies in the case of Candeo and Progresemos for training programs. The next company and group is completely different. The Abrash Group is a much larger and, I suppose, more institutional type and more long-standing emerging market private equity funds. They have invested in Egypt in a hospital group called Cleopatra, which they bought initially as the beginning of a platform on which to tag on other hospitals in Egypt. And they have provided excellent health care, but at affordable prices, which in these countries is not always the case. And Abrash has also, through Cleopatra, received a grant from MEDA and the Canadian government to train and upgrade the nursing skills and to improve quality of care. I stop here because otherwise I can go on and on.
Wonderful. Thank you. One of the unique features of Fund 3 is the OPIC leverage. Can you explain for our listeners what OPIC is and how it has the potential to enhance the internal rate of return?
I will try to be as brief as I can. OPIC is the development agency of the U.S. government. And because of our strategy focus on emerging markets and development and the way we run our programs, OPIC decided to provide catalytic capital to the funds managed by Sarona in the form of a guarantee that allows the funds to borrow from the capital markets and invest the money that the fund has borrowed in equity of the underlying funds. Because those loans that the fund raises, the cost of debt is basically U.S. Treasury rates, so very cheap loans. The difference between the return on equity generated by Sarona and the cost of debt, which we have to repay back, stays in the fund for the benefit of the equity investors. If I have totally confused you, I apologize. The punchline is that for you, the investor, the OPIC facility offsets all the fees and expenses of Sarona, which means that the value that Sarona can bring to this portfolio, which is deal flow, selection, portfolio construction, monitoring, and reporting, is paid for the OPIC facility. So this chart shows you the bottom line is gross return on the horizontal axis, net return on the vertical axis. If it were a normal fund of fund, the net return would be approximately 3, 4, 5% lower than the gross return. Thanks to the OPIC facility, we hope and we aim to provide net returns to our investors that are as high as the gross returns.
Great, thank you. In conclusion, can you share with us one sentence about why investors should consider Sarona Fund 3 at this time?
Well, if an investor wishes to deploy capital to frontier and emerging markets with an attractive risk-adjusted rate of return, there is no alternative. That is a sort of absolute statement. I'll be very happy to back it up with evidence and explanations, but that is in general. In particular, today, given where we are with the strength of the dollar and the level of uncertainty and the level of valuation of companies and investments in these markets, we think there is no better time to actually allocate a portion of your portfolio, investors' portfolios, subject to being able to be illiquid, because it's very important to note that investing in private equity is a long-term game. We will hold cash, our investors' cash, on average between 5 and 6 years, and the fund itself has a 12-year life. So to the extent that you can allocate part of capital to long-term investments for impact in frontier and emerging markets, I think it's difficult to beat this proposition.
Fantastic. Thank you, Vivina, for joining us today and giving our clients and their advisors more insights about Sarona Fund 3. Thank you to our audience for joining us. If you'd like a fund fact sheet on Sarona, you can give me a call or send me an email. My phone number and email address is on the slides. Hope you all have a great day.